Ashburton's Africa Equity Opportunity Fund has done about 14% since it launched in May last year. So it's just over a year old. And in the same period, the index that best represents, we think, African markets has done just over 5%. So that's quite a nice outperformance over the time. We've had a lot of performance during the last year, really from our stock picking. So we've been overweight some of the markets that have done well, Egypt in particular. We've been underweight other markets that have done well, but because we've had the shares in that market that have done the best, Nigerian banks, for example, we've managed to outperform there. So to a large extent, the performance has come from stock picking particularly. Because African markets are quite diverse, and we have countries like Egypt to Nigeria to Kenya, which each have their own political evolution and their own economic changes happening from time to time, and the fund is diverse, we find that African equities in general aren't very volatile. In fact, if you group them all together, they're as volatile as the S&P 500, which is one of the least volatile markets in the world. And at the same time, because the fund's invested in all those markets, it hasn't been very volatile at all. The fund launched in May last year with $20 million, and it's grown to almost $40 million today. And some of that's from the market gains, but we've also had some nice inflows. We've got about 35 positions in the fund, and they're really varied across the continent. We're in about 10 markets across the continent and in a whole variety of sectors. Big exposures, though, are in industrials in Egypt and in banks in Nigeria. If we look at the portfolio as it stands, we have big exposure to Nigerian banks, and so clearly we think they're seriously undervalued, and we think they will benefit from the infrastructure growth that's going to happen in Nigeria, especially in the electricity sector, where they'll be doing quite a lot of lending. And so we think there's going to be loan growth in Nigeria for those banks, mostly coming from infrastructure spend. Egypt is another place we've got quite a lot of exposure. Interestingly, that's a similar theme. The new government there, quite business friendly, but also going to be catching up on the infrastructure backlog that's happened over the last couple of years. So we're quite exposed to industrial companies that we think are going to benefit from that drive. Infrastructure is a big theme across Africa generally, and so in a way we're really accessing those two themes through those two positions. I'd agree with you that it's a long-term play, because Africa is going to be developing for a very long time, and I don't see the current trends as changing. But when you say speculative, I'm a bit concerned that people think that Africa is about high returns but with high risk. And when we're investing bottom-up, it doesn't feel very risky, because we know the companies, we know the company management, or we understand those economies, and we visit regularly and often, and so we don't feel that it's that risky. And that's borne out by the numbers. If you look at the MSCI's Africa ex-South Africa index, it shows that it has as similar, maybe slightly higher volatility, the S&P 500, and significantly less volatility than emerging markets, for example. That's got something to do with the diversification across the continent, but it also shows that Africa as a whole is a lot less speculative than people might think. The improved macroeconomic and business environments, the better politics that's happening, even though it may not look so when you watch from afar on television, but on the ground things are improving, and these changes aren't really going to stop. And if we look at African markets and their diversification benefits relative to global markets, we see they're virtually not correlated at all. 0.27 is the correlation coefficient with Africa with developed markets, and that's really completely uncorrelated. And it's a great diversifier, and it's a great way to invest in an area of the world where the growth is not really dependent on things that happen elsewhere. Obviously, there are a lot of big themes happening across the continent, and infrastructure spending is one of those. Growth in the middle-class consumer, another key change that's happening across the continent. This is typical of early-stage emerging economies, and so we would like, of course, to be invested aligned with those themes, but sometimes it's not possible because, for example, the consumer sector in Nigeria we think is just very expensive, and investors want to get returns. They're not investing because it's a nice idea, and so we're really going to look for value opportunities. However, investing in Nigerian banks, for example, who are going to be lending into the infrastructure area, and where we think they offer considerable upside to what we think are fair values for those banks, is a nice area to invest in. And we're certainly going to be investing across the continent in different themes, in different places, but ultimately to get returns for our investors. If you're investing in companies and you know the management and you trust them and they haven't disappointed you in the past, that gives you a lot of comfort that you think that the management of that company can implement a strategy that will benefit from the growth that they're seeing in their specific economies or in their region. And many companies in Africa are investing enormously in growth, and so Africans are really seeing the benefits and they're prepared to take the risks. But I don't think the risks are that great. From our perspective, we always meet with management teams before we invest in the companies. We travel a lot. We understand as best we can the economies and the political situations in each country and how they might affect the companies that we could invest in or already are invested in. And we think that mitigates the risk quite a lot. We obviously look at liquidity quite seriously. Our fund is weekly traded, so we have to make sure that we can provide people with liquidity on a weekly basis, but we're very comfortable with the liquidity that we have at the moment, and we're not concerned at all. And in effect, I think the risks aren't as high as people imagine.